Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Lightwave logic.
If you find our talks useful, please consider subscribe, like, and comment underneath. And hey, before we really get going, be sure to check out the VIP Algos link below in the description. It is a tool we rely on a lot for spotting these market trends,
Oh yeah, absolutely. The VIP Algos link is right down there. Definitely worth your time if you're tracking these kinds of volatile names.
Yeah, and volatile is the perfect word for today because we are unpacking a bizarre financial paradox, like truly wild.
It really is.
Imagine you're looking at the balance sheet for a billion-dollar tech company, right?
Hmm.
You check the gross margin, which is the pure profit they make on the physical things they sell, and it's sitting at 97%.
Which is just staggering. I mean, 97 cents of gross profit for every dollar moved. That's software level efficiency.
Exactly. It's beautiful. But then, you scroll down to the net margin, the actual bottom line after they pay for all their operating expenses, and you see a number that makes you think your screen is broken.
Oh yeah. Negative 8,000, 700%.
Negative 8,000. It literally defies basic business logic.
Yeah.
You have near perfect economics at the top, but you're losing like $87 for every single dollar you bring in at the bottom.
It looks like a massive money pit at first glance.
Totally. So we're going to figure out if this is a misunderstood genius play or just, setting cash on fire.
To understand that, we have to look at the context of wealth building in this space right now. Lightwave Logic, ticker LWLG, is a pre-commercialization advanced materials company.
Okay.
And the whole reason they have a billion-dollar valuation, despite that terrifying net margin, is their mission. They are trying to solve what is arguably the biggest physical bottleneck in the AI boom.
And they're doing it with proprietary polymer chemistry, right? Working at the atomic level.
Exactly. I mean, the hidden plumbing of the AI revolution is where the real multi-generational wealth gets built.
Yeah, everyone talks about the flashy chatbots or, the big semiconductor brands.
Right, the logos on the servers, but none of that functions without the invisible infrastructure that actually moves the data. Lightwave logic is buried deep in that plumbing.
But before we get back to those wild financials, we kind of need to understand the basic physics problem they're trying to solve, don't we?
We absolutely do. Because if you don't grasp the physics, the balance sheet just looks insane.
Right.
So it all comes down to the electro-optic polymer modulator. In a modern data center, you have thousands of GPUs that need to talk to each other to train these massive AI models.
Because AI requires an absurd amount of data, right?
Exactly. And historically, that data traveled over copper wires using electrical signals. But the volume of data we need for AI is so immense, and it needs to move so fast that copper basically hit a wall.
Yeah, it gets too hot, right?
Yeah, too much heat, too much power consumption, and it's just too slow. So the industry shifted to optics, sending data using lasers over fiber optic cables.
Which makes sense because you literally cannot go faster than the speed of light.
Right, you've hit the universe's speed limit. But, and here's the problem, the computer chip computes using electricity, but the fiber optic cable transmits using light.
No, so you need a translator.
Exactly, you need a highly specialized bridge. That bridge is the modulator. It takes the electrical signal and switches the laser light on and off billions of times a second to encode the digital ones and zeros.
Okay, so electricity goes into the modulator, it triggers a physical change, and pulse light comes out. That sounds simple enough.
In theory, yes. But the incumbent technologies, materials like lithium niobate or standard silicon photonics, they are failing to keep up.
Because of the power demands of the AI boom, I imagine.
Yes, data centers are desperate for power efficiency and bandwidth density. They have to send exponentially more data, but they absolutely cannot use more electricity.
Right, the power grids simply won't support it at this point.
Exactly. So to push more data through a traditional lithium niobate modulator, engineers have to pump more and more voltage into it.
Which causes a chain reaction, right? More voltage means more heat.
Yep. More heat means you need massive air conditioners for the servers, which requires even more electricity. It's a completely unsustainable cycle.
Okay, I want to try and visualize this limitation. Let's think of a traditional modulator like a busy highway toll booth.
I like that.
So the data is the traffic. In the old days, cars had to physically stop, hand over cash, and wait for the gate to go up. That's a huge toll in terms of friction and time.
Right, which represents the high voltage needed to switch the signal.
Exactly. But suddenly, the AI boom hits, and traffic goes up 10,000% overnight. The toll booth is just completely gridlocked.
Yeah, and throwing more voltage at it is like forcing the toll workers to just move their hands faster. Eventually, the system just melts down.
Right, so you can't just use brute force. You can't overcome the physical properties of the material.
Which is where Lightwave Logic's fundamentals come in. They aren't trying to build a faster toll booth, they are changing the material of the highway itself.
Using this proprietary polymer chemistry.
Yes, specifically these perfluorinated polymer systems, they fundamentally alter how the modulator interacts with electricity.
Right, the custom chromophores.
Yeah.
These light-absorbing molecules. There's a metric here called the high electro-optic coefficient, or R33. Break that down for us.
Sure. So instead of a physical toll booth, think of this polymer as an easy pass lane. These chromophore molecules are shaped kind of like microscopic antennas.
Oh, wow.
Yeah, and when a very tiny electrical voltage hits them, they physically align and change orientation instantly.
Which changes how the light passes through.
Exactly. It changes the index of refraction with virtually zero friction. Because they are hypersensitive to electrical fields, that's the high R33 value, it takes a microscopic amount of electricity to trigger the change.
So it's way faster and uses a fraction of the energy.
Precisely. And for a hyperscale data center running thousands of GPUs, cutting power consumption on your optical interconnects is the holy grail. It saves millions in electricity.
Okay, so they have this easy pass lane. The obvious question is, why hasn't every massive tech company just bought this polymer today?
That brings us to the harsh reality of data center integration cycles. Lightwave isn't manufacturing the entire optical package. They want to integrate their polymers into existing silicon photonics platforms.
Right, the physical chips where the optical parts already live.
Yeah. But you can't just swap a core material in mission-critical infrastructure overnight. It triggers a grueling 12 to 24-month prototype validation cycle.
They have to stress test it, right?
Yeah.
Extreme temperatures, chemical stability, all that.
Oh, absolutely. Because if an optical engine fails, the AI stops learning. The cost of failure is astronomical. But that integration cycle is a double-edged sword.
How so?
Because once a major player spends 2 years validating Lightwave's polymer, the switching costs are enormous. They are effectively locked in.
Ah, I see. They won't spend another 2 years qualifying a competitor.
Exactly. Combine that lock-in with Lightwave's global patent portfolio, and you have an incredibly defensible moat.
Okay, that makes sense. But let's crash back into the financial reality because we have to talk about this balance sheet. I refuse to give them a pass on this.
Fair enough. The numbers are brutal.
Right. Revenue growth is up 175.9% year over year. But from a microscopic base, we're talking low hundreds of thousands, maybe low millions.
Yeah, it's very early stages.
And then the 97.13% gross margin is great. But the net margin is negative, 8,724.83%. Earnings per share is negative 15 cents.
It looks bad.
It's negative free cash flow, no buybacks, no dividends. Every cent goes to R&D and patents. At what point is this just an incredibly expensive science experiment?
Well, the skepticism is completely warranted if you only look at current cash flow, but evaluating a pre-commercialization materials company on net margin is, well, it's applying the wrong metric.
Okay, break that distinction down.
It's a scale problem, not a unit economics problem. If you have bad unit economics, it costs you more than $1 to make something you sell for $1. Scaling that just bankrupts you faster.
Right, like early ride-sharing companies subsidizing rides.
Exactly. But Lightwave has a 97% gross margin. The raw cost to synthesize the polymer is incredibly low compared to its licensing value.
So the negative 8,700% margin is entirely overhead.
Yes. Clean rooms, PhD chemists, international patents, buying time on semiconductor fabrication lines, massive fixed costs.
And right now, those costs are supported by just a tiny trickle of revenue.
Right. But once commercial production scales, almost every new dollar of revenue falls straight to the bottom line because the R&D is already paid for.
Okay, and the market clearly sees that potential. They've got a market cap of roughly $1.058 billion, and their price-to-book ratio is 13.02x.
Which means investors are pricing them at 13 times their physical assets. Desks, servers, lab equipment, because they are valuing the intangible intellectual property.
So valuing the patents, yeah.
Exactly, but that valuation requires a massive catalyst. And that's what Wall Street is watching right now.
The 2027 tipping point.
Yes. The core investment thesis hinges on their 2027 commercial production target. That's when this transitions from a lab to a real commercial enterprise.
And there's a serious tug-of-war in the market narrative approaching that date. Like in July 2026, we saw an analyst upgrade with a buy rating and an $11 price target.
Which is about a 60% upside from current levels.
Yeah, But then, just weeks before that, another analyst called the stock a complete gamble and slapped a hold rating on it, pointing right at that cash burn.
The divide is wild. But that July upgrade didn't just appear out of nowhere. The analyst cited the rumored Marvell Polariton setup.
Okay, let's dig into that.
Yeah.
Because Marvell Technology is a heavyweight. They provide data center silicon photonics to the biggest tech companies in the world.
Right.
So if Lightwave's polymers are being tested from Marvell's platforms, that changes everything, doesn't it?
It validates the technology at commercial scale. Silicon photonics is the engine of the data center, and Lightwave is trying to be the new high-performance fuel.
So if Marvell signs off, 2027 isn't just a guess anymore. It's a scheduled rollout with a major partner.
Exactly. Validation from a Tier 1 provider is the only way to silence that complete gamble narrative. And we are seeing this extreme tension play out in the technicals.
Yeah, let's talk price action. The stock is at $6.87. It had a strong day, bouncing up over 6%.
But if you zoom out, it's down 63.3% from its 52-week high of $18.70. It's taken a beating.
Still up 390% from its 52-week low of $1.40, though.
Right. It's a classic high beta stock. The beta is 2.47, meaning it moves almost 2.5 times as aggressively as the broader market.
With the stock crushed over 60% from the highs, you kind of have to wonder if the internal team is panicking. Is this just a dead cat bounce, or is there actual conviction?
Well, the sentiment data gives us a very clear answer, and it comes down to insider buying. Yeah, trading volume is incredibly low right now, about 0.47 times the 3-month average.
So the weak hands have already panic sold. The stock is just quietly consolidating.
But beneath that quiet surface, the insider MSPR, the management sentiment price ratio, is sitting at a fiercely bullish 99.03.
Let's explain MSPR for the listeners. It isn't just a tally of buyers versus sellers, right? It's a dollar-weighted metric.
Correct. It accounts for who makes the trade and the financial weight relative to their compensation. If a mid-level guy sells a little to cover taxes, it barely registers.
But if the CEO is aggressively buying on the open market, it skyrockets.
Exactly. And over the last 90 days, there have been 6 major insider buys to only 2 sells.
Wow. So a score of 99.03 means management is accumulating shares with absolute conviction.
They are looking at the same 63% drop as retail investors, but they are the ones looking at the actual lab results. It's a massive positive divergence.
It is. But look, even with insider buying, maintaining a billion-dollar valuation requires absolute perfection.
Oh, without a doubt. One delay in the lab, one failed thermal test, and 2027 evaporates.
Which brings us to the bear case and the very real risks. The company-specific risk is terrifying. Their price-to-sales ratio is 4,353.9x.
It's astronomical.
Right. And the binary risk of failure is severe. If they miss 2027, the cash burn continues. They'll have to dilute, issue millions of new shares, and the stock price will just death spiral.
That internal race against time is daunting, but honestly, the external macroeconomic risks are arguably worse and totally out of their control.
Yeah, the geopolitical data from July 2026 is pretty grim. Middle East escalations, U.S.-Iran military conflicts.
Exactly. There's a blockade of the Strait of Hormuz drastically slowing global vessel traffic, compounded by the breakdown of the Gaza ceasefire.
Okay, but wait, let me think about the mechanics here. Lightwave is a U.S. company. They make polymers in domestic labs for U.S. data centers. Why do they care about the Strait of Hormuz?
You have to follow the macro chain reaction. The Strait of Hormuz handles a massive percentage of global oil. When it's blocked, energy prices spike instantly.
And the single largest variable expense for a hyperscale data center is electricity.
Exactly. If global energy costs skyrocket, the tech giants' electric bills triple. They have to tighten their belts.
So they freeze corporate spending. They delay capital expenditures on new infrastructure.
You nailed it. A next-gen optical engine prototype slated for 2027 gets pushed to 2029 just to save cash. Lightwave gets delayed, not because their polymer failed, but because the customer froze the budget.
Man, that's brutal. And in a geopolitical panic, the broader market goes risk off.
Yeah, institutions dump volatile assets and flee to treasury bonds. With a beta of 2.47, Lightwave gets disproportionately crushed in a panic.
Even if their chemistry is flawless, a macro shock could literally starve them of capital before the commercial orders arrive.
That is the ultimate vulnerability of being pre-revenue. But to balance that bearish view, there is a powerful domestic counterforce.
The White House Gold Eagle initiative, right?
Yes. It focuses heavily on cybersecurity vulnerability and domestic infrastructure.
But how does the cybersecurity initiative help polymer modulators?
Because it signals a massive federal mandate to secure U.S. tech infrastructure. The government views advanced data centers and AI capabilities as critical national security.
Oh, so it implies federal funding and policy support to make sure these domestic supply chains succeed.
Exactly. That federal tailwind provides a highly supportive environment for deep tech companies like Lightwave, potentially insulating them from some of the global chaos.
Okay, taking all of this into account, the physics, the negative margins, the Marvell rumors, the macro risks,
Right.
what is the final verdict here?
Based on the data, it's a bullish score of 7 out of 10. The conclusion is that this is an asymmetric multi-year hold, a strict 12 to 24-month horizon.
So high risk, but the market has priced in a lot of that failure probability with the recent 63% pullback.
Right. A 7 out of 10 reflects the extreme tension. You have revolutionary tech and insider buying on one side and severe dilution risk on the other. It requires an iron stomach for volatility.
It really does. If you found this breakdown valuable, remember to subscribe, like, and drop a comment below. And definitely don't forget to click that VIP Algos link in the description. It's an incredible resource for navigating exactly this kind of market turbulence.
Yep, link is right down there.
It leaves you with a really compelling thought to mull over. As AI pushes our global data infrastructure to its absolute physical limits, who is actually going to capture the wealth? Will it be the legacy silicon giants desperately pumping more voltage through outdated materials?
Or will the real value be captured by hyper-specialized polymer chemists working invisibly at the atomic level to remove the friction entirely?
It really makes you look at the hidden plumbing of the internet in a whole new light.
Yeah.
Thank you for joining us, and we'll see you next time.